Good afternoon, students. So, this is the last session on the financial ratio analysis. In this ratio, in this session, we will study one 15 marks problem, and these are some important problems we have seen, and we have selected the problems which are having in that problem many ratios are asked. So important ratios we have studied by taking or by selecting the different problems in different sessions. So here in last sessions we will select one simple problem, that is 15 marks problem. These all questions are selected from the exercise problems. So here the problem is Hubli Company Limited, which presents its statement of assets and liabilities for the year ended 31/12/2017. So here shareholders fund. So share capital is note 1 and the share capital is 70,000. Reserves and surplus, that is in reserves and surplus it is given as profit and loss 2 lakh, that is 44,000, and the total shareholder fund is 1,14,000. Next, non-current liabilities. Under non-current liabilities, long-term borrowings, that is note 3, and under this 5% mortgage loan, so the total amount is 80,000. And next, current liabilities. Under the current liabilities, trade payables. So trade payables includes bills payable under note 4, so 30,000 is given, and other current liabilities, that is tax, under note 5. So total the current liabilities are 50,000, and here the total liabilities are 2,44,000. Same, this is also a vertical balance sheet. And now we'll see assets. So assets, here the main heading is non-current assets. Under that, fixed assets. Under the heading of fixed assets, the tangible assets under note 6 is 40,000 is given. So current investment as per note 7, that is investment short term 24,000. Inventory is under note 8 1 lakh. Trade receivables under 9 6, and cash note 10 20,000. So total we are having the 2,04,000 as current assets and the tangible asset as 40,000. So the total assets is 2,44,000. We have seen the total liability is also 2,44,000 and the total assets is also 2,44,000. Now it's our turn to calculate some of the asked ratios. So first of all, see what the notes tells. So first, note 1 tells about share capital. Here the share capital includes 5,000 equity shares of rupees 10 each is 50,000, and 13.5% preference share capital of rupees 2 lakh. So total 20,000. So total we are having the share capital as 70,000. And note 6, as per note 6, tangible assets are plant 2 lakh, and depreciation from the plant is 40,000. So here after deducting depreciation we are getting 1,60,000 as total net tangible assets. So trade receivables. So we know trade receivable is debtors, and the previous year's debtor is 40,000, but here the current year debtor is 60,000. So here other informations are given like this. Stock at the beginning is 80,000. Purchase is 1,20,000. Gross profit is given as 1,40,000. Sale is given as 2,40,000, and stock at the end is 1 lakh, that is closing stock is 1 lakh. So expenses. So selling expenses 30,000, administrative expenses 40,000, and the total non-operating incomes are 70,000. So here we got stock at the end 1 lakh and 70,000 as net operating income, less interest 12,000. So after deducting interest from net operating incomes we are getting 58,000 as balancing figure, and from that if we deduct income tax 29,000, so finally we have got net income after tax. So that is net profit after tax is 29,000. So by this is the information given in the problem, and we have to, from taking into consideration the given information, and we have to find out current ratio debtors turnover ratio, debt collection period, inventory turnover ratio, earning per share and debt equity ratio. So this is also a mixture of ratios. Here we have to calculate all the things, and we have seen one thing yet, in all sessions the current ratio, in all problems current ratio is asked, debtors turnover ratio is also asked, debt equity ratio. I hope these are some important ratios which are to be studied very carefully for the purpose of examinations. So here, so first of all, we will move to answer, that is working note. First, for calculation of current ratio we need current assets. So here in this given problem, the current assets as current investment of rupees 24,000, stock rupees 1 lakh, debtors 60,000, cash 20,000. So total we are having current assets as 2 lakh 4,000, and the current liabilities 50,000. Calculation of cost of goods sold. So cost of goods sold is calculated by deducting gross profit from sales. So gross profit is already given in the other information, in the problem as other information. So here sale was 2,40,000, from that 1,40,000 is deducted as gross profit, and we are getting cost of goods sold as 1 lakh. Calculation of shareholders fund, the equity capital plus preference share capital plus profit and loss. So here this is shareholders fund, it is not equity shareholders fund, it is total shareholders fund, and equity capital is 50,000 and the preference capital is 20,000 and the net profit and loss is 44,000. So we are getting 1,14,000 as shareholders fund, and the profit available to equity shareholder is profit after tax minus dividend on preference share. Here net profit after tax is to be taken, and from that dividend is calculated. After deducting dividend from net profit after tax, we will get the profit available to equity shareholder. So now calculation of external liabilities. So here external liabilities are mortgage, because external liabilities are given or calculated to find out the bearing, that is debt equity ratio. To calculate debt equity ratio we need the external liabilities. So here external liability is mortgage loan 80,000, bills payable 30,000 and tax payable is 20,000. So total external liabilities are 1,30,000. And average debtors is given. Here average debtors can be calculated by opening debtors plus closing debtors divided by 2. So opening debtor is 40,000 and the closing debtor is 60,000, and if 1 lakh is divided by 2 means we will get 50,000 as average debtors. So finally we have to calculate average inventory. So average inventory is nothing but it is a opening stock plus closing stock divided by 2. So here opening stock is 80,000 and the closing stock is 1 lakh. So 1,80,000 is divided by 2 and we are getting here average inventory as 90,000. So here now after calculating all these things, that working notes, in working note we have calculated current assets, current liabilities, cost of goods sold, shareholders fund and profit available to equity shareholder fund, and external liabilities, average debtors and average inventory. After finding out all these things, now it is very easy to calculate the ratio. So first ratio asked is current ratio. So current ratio is calculated by dividing current assets by current liabilities, that is 2,04,000 divided by 50,000. We are getting 4.8:1 as current ratio. Debtors turnover ratio is calculated by credit sales divided by average debtors. So credit sale is 2,40,000, it is given in the problem, and 50,000 is average debtor, which is calculated in the working note. So now we will get the debtors turnover ratio as 4.8 times. Debtors collection period, when it comes to number of that is period, calculation period, it is calculated by number of days is divided by debtors turnover ratio. So here number of days in a year is 365, and already we have calculated the debtor turnover ratio is as 4.8. So when the 365 days is divided by 4.8, we will get 76 days as debtors collection period. Inventory turnover ratio, the cost of goods sold divided by average stock, and cost of goods is 1 lakh divided by 90,000 means 1.11 times. EPS, This is profit available to equity shareholders divided by number of equity shares. Only equity shares are considered. Here profit is 26,300. That is after deducting dividend. In working note we have clearly given, we have calculated the profit available to equity shareholders. That is 26,300 divided by 5,000, which is equals to 5.26. Debt equity ratio, that is external liabilities divided by shareholders fund, and the external liability is 1,30,000, which is calculated in the working notes, and the shareholder fund is 1,14,000. So we got 1.14 is to 1 as debt equity ratio, and the debt equity ratio is calculated with the use of another formula, that is long term debt divided by shareholders fund. Here long term debt is 80,000 and the total shareholder fund is 1,30,000, and the ratio will be 0.615 is to 1. So like this the different ratios are calculated here. So here I tried to explain you all the ratios in a very systematic manner with simple problems and with exercise problems, and taking 5 marks and 15 marks, which is very helpful for your exam preparations. So I hope you all understood all the sessions, that is the total chapter, the whole model is understood by you. The financial ratio analysis I tried to express you in a very simple language and simple way, and the simple calculation, with the help of simple calculations, and also by taking the simple problems at every after the theoretical aspect, every the theory about the ratios, after the formula for every ratio I have tried to express you or explain you the particular ratio very systematically and very in a useful manner. I hope you all understood all the sessions in this model. Thank you. If you have any comments or if you have any doubts, so put the comments and I will try to answer your comments. Thank you one and all.